Well, welcome everyone. I'm Steve Savant, your edu-trainer and coach in the entry level for life insurance. And today we're talking about types of life insurance. People say, well, gee, Steve, it took you 10 episodes to get to the thing we want to talk about. But I kind of got to lay the groundwork, some understanding. And believe you me, there's a lot more to do because we're trying to do it at an entry level where everybody can understand the basics. And we're in our basics series still, in our fifth series of that. So when I'm looking at this, I want to remind you that our edutainment workshops are sponsored by Lincoln Benefit Life, an Allstate company. And why do we have them as our sponsor? Because we elected their software called Eclipse Software Proposal System there as probably the best user-friendly software that we have. Remember, we have 80-something carriers inside, and we elected them the easiest to use. And if you're coming into this business, maybe you're a property casualty agent, perhaps you're medical, maybe you're coming in from the securities or banking, or you're an annuity producer. You say, gee, I don't have really that much training. If you'll go ahead and download this and go out and download it at www.lblsales.com/ETW. That's www.lblsales.com/ETW. Download it right on the Run installer as soon as you come to the site. Download it so that in the weeks to come when we're online using the proposal system, you can dial it in, you'll have it all ready to go, and you'll be able to go page by page to the proposal system with me. I think it's a huge value. Also, remember, we're giving away the Life Manual with vocabulary list. I mean, it's great. Definitions. You'll never have to get lost. You have it always in your vocabulary. We're giving that away. All you have to do is write me, thebiz@brokersalliance.com, thebiz, THEBIZ @brokersalliance.com, and we'll send you that. And everything you're going to see today is you can get in the manual. So without further ado, I want to walk you through some of the types. And there are a lot. Now, interestingly enough, the only reason I'm going to bring up some of these is because they're still out there, but hardly anybody uses them that much anymore. There is decreasing term. We used to do this with mortgages. As your mortgage decreased, so did your term life decrease. But most people now are using a different platform for that, but it's still around, and so some people may use level premium, but it's just decreasing coverage, and it never usually has cash. And just a little heads up, a little thought here. When we talk about this, there's always this issue of, are we talking about a temporary life insurance, or are we talking about permanent life insurance? This is a temporary form of life insurance. And my acronym, I like to use this word, TERM for term. Temporary expense reimbursement money. If my liability is temporary, whether it's taxes, debt, whatever my liability is, or earnings that I have to, so that if I'm not there, my family gets to live out our lifestyle dreams, whether I'm there or not. When I'm looking at that, is it a temporary obligation or is it a permanent obligation? PERM, permanent expense reimbursement. So when I'm looking at this, annual renewable, decreasing term, annual renewable term, and long-term level term, premium term, are supposed to be temporary. Now we'll get into that in a second because you could make long-term term life insurance into a permanent through conversion. We'll get into that in weeks to come. So annual renewable term, there are companies still selling ART out there, annual renewable term. And so sometimes if you say, I just need it for a couple of years. In fact, actually the last time I used this, we went to a client because of the 3-year rule based on estate planning. And we didn't want to have any problems with ownership issues because the 36-month clock, again, we're going to have to get into that. I'm getting a little bit too much ahead of myself. But I needed a small ART just to protect the client in case taxes occurred by death during the first 3 years of their new estate irrevocable life insurance trust. Because we were actually putting money into something that already existed. So we wanted to make sure, is that going to be okay? So we used ART. Then the traditional ones that you see now. Think about what I'm saying. This only shows 5-year level, 10-year level, 15-year level, 20-year level, but we have 25, we have 30, and now we even have 40-year level term. I've lived to see the day. Then, of course, we have whole life. And the whole life we have, there are whole life contracts that do not allow or don't have dividends so that they're non-participating. Some of these whole life contracts actually have participation or dividends. And those dividends are a return of unused premium. So whatever they don't need out of the premium the client had, if they were really effective in their investments, if they were effective in their expenses, they're going to return any unused premium to the client as a dividend. And then there's universal life. Now, there are many areas of universal life. And we're talking about the 4 platforms. They have current assumption universal life. They have indexed universal life. They have guaranteed universal life. And that they have variable universal life. Now let me just break it down a little bit in basic. These are like mortality chassis or platforms. Universal life is basically built on an interest rate. It's current interest rates. Whereas an index is tied to indices. They could be foreign, they could be domestic. You could be looking at guaranteed universal life, which is generally used for indemnification. It rarely has cash values, although there are carriers that endow their death benefits, but they're usually at age 120 or beyond. So, and then the third is variable, which is tied to equity positions in subaccounts. Could be equities, bonds, whatever, but they have different platforms for universal life. One of the attractions of having those advantages is that you're able to say, well, my risk factor or my beta risk factor or my tolerance, risk tolerance as a client is kind of low. So you may choose, I'm going to do interest. Or you may use indexed UL because most of those contracts actually have preservation of principal riders or it's built inside their chassis. And some variable contracts have some protection, but basically you could lose all of the sub-account money. So you have to be very careful if you're going to be using that. You have to be a long-term player. You have to understand the market. And most people that are selling it aren't really good asset allocators. So you want somebody professional to make those calls on your asset allocation, rebalancing, and especially your long-term views. As you get older, you're going to have to change that and rebalance. So when I'm looking at that, that's a whole other area. And as I said, variable, it's a security. If you're not at least Series 6, you cannot sell variable life, and you really can't talk about it. And anytime you get into an annuity that's a variable annuity, although that's not in our show today, we have to be security licensed, Series 6 minimum, and of course if you're in your state, you have to have the Series 63. Now, I'm just looking at basic. And then last one, single premium whole life. Some people like to do single premium whole life because they have a guaranteed single deposit and they're done. Although, heads up, if you wanted to use guaranteed universal life, some contracts allow you to do single pay, 10 pay, 20 pay, and you're done. Some will even go to age 65. I've noticed that some whole life contracts also do the same. They'll do a 10 pay, a guaranteed 20 pay, or a guaranteed 65. So there's no question, do I have to pay any more? You don't have to pay any more when you elect these kind of contracts. So whether it's single pay with whole life or I'm using universal life, I can kind of guarantee one time, one shot, here's my single deposit, here's my death benefit, and I don't have any other obligations. I want to make a heads up to make sure that always that my endowment or maturity date is way past my projected life expectancy. That's a big thing to think about when you do. Now, when I'm looking at long-term level premium, term insurance now is on these platforms, 5, 10, 15, 20, 25, 30, and yes, 40. So when I'm looking at that, I'm trying to gauge how long my liability or obligations will be. And I can actually customize that down. Some carriers, believe it or not, actually don't use 5-year increments anymore. They actually will put a specific year. You want to do 16 years, you want to do 18 years, you want to do 21 years, they'll actually let you mark to mark when you think your liability. That's very customization. That's how we've tailored term in these days. I mean, it's really become quite micromanaged. So I can pick and select any of these ideas from level term to take care of a temporary expense issue. So that's why I look for it, I use it, and remember, it's so inexpensive now. I think I mentioned in last week's show that I looked at a female super preferred at $100,000. Her $75 policy fee was greater than her annual premium. Well, I've lived to see the day. So you can use term, and in these increments, or some carriers have already went off the traditional or conventional, and they'll mark to the year that you want the term to go to. Permanent insurance, whole life, guaranteed universal life, indexed universal life, variable universal life, these can go all the way out to age 120. Some of them will actually go a little further than that, but some of the carriers that go farther than that actually state in the contract life of the client, or life of the insured, actually is the better phrase. So when you're looking at these different modes, different ways of paying it, remember they're built for one reason. The original reason is indemnification, to protect. They're built for indemnification, for coverage. They're there to have money to actually replace or indemnify the survivors and beneficiaries. That's why it's important to know that even though we do have secondary issues like supplemental retirement income, the number one primary reason for life insurance is indemnification. When you think about it, what's the goal of indemnification but to create a lifetime continuity, your lifestyle continuity? I see your lifestyle now. Do you want that maintained whether you're here or not? Do you want your children to enjoy that whether you're here or not? I always want to know lifestyle. What's your goal in lifestyle continuance? What level of lifestyle continuance do you want me to maintain? And as I showed you a couple days ago when we did our calculation on our worksheets, you can actually put that in there and input it in there and come up with a calculation that will justify the insurance that you're asking for. When I go through these lists, this is the generic list. We're going to be managing this into the ground in the weeks to come. We're going to show you some of the ideas that you have. Most of the people that are out there right now, when they come into our area, they usually sell not permanent, but temporary or term insurance. If you're coming into the business for the first time, there are several great spreadsheets and product grids that'll map out all the carriers that are players in the term market. They'll map them out by duration. They'll also be able to tell you, here's all their riders, conversion windows, all the things that are spec'd out in the policy. Policy provisions then are summarized by several services that we use, EBIX being one of them, and they will summarize those policy specs from the policy provisions inside the contract. So you can look at it at a glance and compare them side by side. So if you're coming into our business for the first time and you want to dip your toe into the life insurance, we recommend entering in through the easy access port of using term insurance for temporary expense. Now, of course, if you get to a place where there's a permanent need, you're going to have to go to permanent. But I'm saying this is a pretty good place to enter into, and I look at it, you're going to say, wow, this is pretty good, because you actually, instead of reading the entire policy, most of these surveillance systems or these monitoring systems like EBIX for vital signs and for vital term and for guaranteed universal life, these are excellent tools because you can do side-by-side term comparison and say, that's pretty good. Or with their guaranteed universal life, you can do the same side-by-side policy provisions. So I like that because here's my list. I know all the things we're going to be talking about later on, whether it's all the riders, contestability issues. I want to know what the actual modal premium, am I going to pay annual, am I going to pay semi-annual, quarterly, monthly through a draft. I want to know, can I pay my insurance up front? Some term insurance carriers allow you to pay the 5-year all one shot and get a small discount. There's all kinds of ways to play. You just have to know. And in that digest or that spreadsheet, and if you call us or actually write us at thebiz@brokersalliance.com, we'll send you an example of that, and you can say, hey, I got my license, Steve, I got a case. I want to see all the term carriers. I want to see all the GUL carriers. I want to see their provisions in their policies, and we have that. And the reason I like it is because it really puts you in the position to show your client you've shopped the product. You're not a single shingle provider. You're showing all the entire market plus the policy provisions so that your client or your client's fiduciary can look at those policy provisions side by side and then gauge and make an informed and educated decision. These are all the platforms that we're going to be talking about as we get into the next couple of weeks and months of training entry level into life insurance.